Hey guys, how's it going? Option Sniper. I'm going to wait a couple more minutes before we start. Today we're going to talk about market cycles. We're going to talk about earnings. We're going to talk about the Ichimoku Cloud and one other thing. Expiration Friday. Yeah, Expiration Friday. And how the market performs usually leading into Expiration Friday, and that whole week, the third week of the month, is Expiration Friday week, which we just finished last week. Let's see if we can get a couple more people. We have 7 people, so all right, I'm going to start here in a couple more minutes. All right, here we go. So, as always, I want this to be as interactive as possible. So, I'm going to check back every so often, and hopefully people have questions. And the questions don't necessarily have to be about what we're going over. If you have any questions and anything that you've been wondering about, I'm happy to help, and that's why I'm here. That's why this is live. So, we're going to start now. Okay, so what's happening right now in the market is very important for everybody to be aware of. We're in a cycle of sideways choppy movement, which is more common in the market than a trending market. And we've been in this cycle of chop now for between 6 to 7 weeks. The sooner that you can identify the cycle that we're in, the easier time you will have trading that cycle. In a choppy sideways market, it's a lot tougher to trade in general, and it's also a lot harder to take a lot of profits because the market doesn't go in one direction, right? It goes one way and then comes back the exact way in which it came. It's mean reverting, meaning the market moves one way and then it just comes right back to where it was before. So in cycles like this, in a non-trending chop cycle, you have to be ready to take your profits faster. You need to expect the market to come back in the direction from where it came, meaning no trend, meaning chopping sideways back and forth. A lot of movements don't make sense, and even more so during Expiration Friday week, like last week. I think it was Wednesday, the market sold off. We closed at the lows, and then the next day we rallied. And that's the type of movements that you see in a non-trending choppy market. And it's also even more prevalent during an Expiration Friday week because there's so much. So my theory and my belief on the stock market, on the equity market, in Expiration Friday weeks is that the derivatives market drives the equity market, meaning there's so many options that are expiring the third Friday of every month. There's so much interest in that's what drives market movements. So a lot of the time, the market movements the third week of every month makes even less sense, especially when the market's choppy already to begin with. So like I said, it's best in a non-trending choppy cycle to not trade as much, to have less trades on, and obviously to take your profits faster because they'll evaporate faster, right? And we haven't been in a trending cycle now. It's been almost 2 months since the last actual like smooth sailing trending cycle. And that's why it's been, more tougher sledding these past 6 to 7 weeks. And it will get better again like it always does. We will start trending in one direction. We're still in a bull market. My opinion is that the market can really go either way, and really what's going on right now in the market is really, really focused on tax reform and regulation easing. And that's really why the market rallied to begin with when Trump was elected, because of the expectations of those things happening. But once the market saw that how tough it was to get healthcare through, things started to change a little bit. Now, healthcare is probably one of the most complicated things to pass to begin with. I think tax reform should be a lot easier. So we'll see how that goes, but that definitely, seeing how healthcare turned out was definitely not reassuring for the market, which is why it's been so choppy these past 6 to 7 weeks. And so we need these things to happen for the next leg up and for the market to continue its bullish trend. And if everybody saw on Friday, Trump came out with he came out with, I think, 3 to 4 executive orders. He also came out with an announcement on Wednesday of this week. There's going to be a big announcement regarding tax reform, and that definitely has the potential to move the market in either direction, more likely to the bullish side if it's good news, in my opinion. But that's going to be a big thing on this Wednesday. And then we also have some key earnings coming up this week. This is the biggest earnings week of the quarter. The third week in April, the third week in July, the third week in October, and the third week in January. Those are the biggest earnings weeks of every quarter. So this is the biggest earnings week of the quarter coming up this week. That really drives the market a lot of the time, earnings for bigger companies. Google and Amazon are reporting on the 27th. And then I have, a company that I've been very bullish on, Win. Win is reporting this Tuesday. Usually they report the first week in May, but they moved their earnings up a week, and they're actually reporting the beginning of this week. And I haven't seen many times companies move their earnings reports earlier if they think their earnings report's going to be bad. So there's that. My opinion on Win is that it's definitely going to have in my opinion, it's going to have a good report. I won't say definitely. Obviously, I'm not always right. But I think last quarter was its first good quarter in a good amount of time, in about 2 to 3 years. And I think that trend will continue as gaming revenues in Macau and China continue to gain momentum. So I want to talk more about these cycles. The first thing we're looking at here is the weekly chart on the S&P 500. These are weekly candlesticks, and right away we can see we rallied, right? So we were in this uptrend cycle for 1, 2, 3, 4, 5, 6 weeks. So 6 weeks we trended strongly to the upside. That's where the easy money's always made, is when the market's trending. Now, since we topped out and we hit 2,400, we've now been 1, 2, 3, 4, 5, 6. This was our 7th week of really not going anywhere. So 7 weeks. 7 weeks where we've been between pretty much 2,350 and 2,400 in a 50-point range. Pretty much. Besides the week before, we closed, around 2,320. But still, the 80-point range. The market really hasn't gone anywhere, like I said, in the past 7 weeks. So the sooner that you can identify a cycle like that, the better. Because you'll be able to trade it accordingly. You don't trade choppy cycles by expecting the market to move big in either direction. You trade choppy cycles by opening a trade and taking your profits when you have it, because it's likely that the market's going to go back in the opposite direction and take out all of your profits that you have if you don't lock them in. So, I mean, this could have been identified if you were really trying to identify and I've been talking about this chop cycle for a while, but moving forward, if you're really independently, you're on your own looking at these charts and you're trying to identify what the market's doing, this is where you start, right? You start by saying, what cycle is the market in? Are we trending or are we chopping? Those are really the only two cycles to be in. You can be trending down, you can be trending up, or you can just be chopping. And more times than not, the market is chopping, okay? It's less prevalent that you see a trending market. It's more common that you see a choppy market. And trending markets, like I said, that's the best time to make easy money, right? You put on a trade, you can hold it for weeks at a time and let the market just run in your direction. And then when that ends, you have to adjust to this sideways cycle. So really this cycle could have been identified up in here, right? We topped out at 2,400 and then we saw it for 2 weeks straight. We didn't go anywhere. That's kind of where you can identify, okay, this uptrend is now over. We're now in a different period, a different cycle in this market. So that's really what the most important thing that you need to do as a trader is. The first thing, identify the cycle that the market's in. And now the market has now been in this cycle for 7 weeks. So it's coming closer to an end. Okay. And usually, I mean, the longer time period that a market stays in a choppy cycle, the stronger the move is going to be when it starts trending again. So, but yeah, 7 weeks is a pretty solid time to be not moving anywhere. But I mean, you see here, this is a great example of, this was like months of sideways chop in the S&P. And this was like leading up to the election. So this isn't by any means a super long time, but it is, getting kind of long in the tooth, and we should expect to see the market start trending sooner than later. But we are still in a chop cycle, and that's very important to be aware of because you have to trade accordingly, right? So let me stop here and see if anybody has any questions before we continue. Yes, Raghu asks, very good question. How about selling options during non-trending cycles? That is the ideal strategy, Raghu. That is definitely the ideal strategy. Credit spreads, right? Credit spreads, iron condors. Sorry about that. Iron condors and credit spreads, or just shorting options. Which, guys, you have to remember, 80% of options expire worthless. So what is the smart money doing? The smart money is shorting options a lot of the time, or selling options, whatever you want to call it. Big money is just shorting them, and because they have so much money that they have enough margin to short. But a good alternative for people with smaller accounts is credit spreads. So yes, Raghu, in a choppy market, credit spreads, iron condors, and just shorting options is the ideal strategy for sure. So that's a good question, and that is kind of the better strategy, right? Is to be doing those types of things. Or when volatility kicks up, like it has been these past 3 weeks, the VIX has been elevated. It's a good time to still be trading, but you just have to capitalize on the swings. You can't expect to be riding out the market big in either direction. When you get a swing, you lock it in, take your profit, and then trade the next swing and hold for shorter time periods. So whenever the VIX is elevated a bit, it's a better time to trade options. And what we've seen is it was elevated these past couple weeks. It was at 15, 16. So it was a better time to be trading. It's just you got to trade the cycle that we're in. But yes, selling and credit spreads is a great strategy to use in a market that's not trending. Okay, so this is the daily chart of the S&P 500, and what we saw last week was really just chop, just what we've been seeing, and there's really, I mean, this chart really doesn't. It just shows that we've been in chop, right? I mean, it doesn't really say anything. The one thing that we do need to be aware of is the 50-day SMA on the S&P 500. We're still below that. That is 2357. We want to see the market get back above that. If you're a bull, you want to see the market get back above that. The longer the market stays below the 50 SMA, the more bearish that becomes for the market. And we have been pretty much, 2350 has been a pretty decent magnet on the market now for 6 to 7 weeks. And the really key level to the downside is this low right here, right? So 23.25. If the market breaks 23.25, we definitely have a good way down to fall. And that is going to tell us. So this range here, this 23.75 to 23.25, this 50-point range, whichever way we break that, it's likely that we start trending again in that direction. So there are some, like I said, there are some key things coming up this week that can get the market trending again. And that's the announcement on tax reform on Wednesday, and then earnings reports of some, there's a lot of big companies reporting. I just cite Amazon and Google because they're more volatile. You know, they move a lot after their reports, and so doesn't Win. But there's a lot of big companies reporting this week that can have an impact on the market and really have a definitive decision on where the market decides to move and start trending again. Now, like I said, the longer we stay below the 50 simple day moving average, the 50-day simple moving average, the more bearish that is for the market. And we've now been below it now for 6 days. 7 days actually, we closed below it here. So 7 candles now we've been below the 50 SMA. And it's been acting as actually pretty good resistance. We've seen it's been acting as pretty strong resistance now. So we'll see this week. This week should be important to see if we can actually get back above the 50 SMA and start trending back to the upside. And that's about it for the daily here, but we're just basically seeing the same cycle, right, on the dailies as we are in the weeklies. It's just, that's why, especially during the weekend, after a week, we should always be looking at the weekly candles on the S&P. It just gives us a more cleaner picture of price. Okay, so now I'm going to talk a little bit about Expiration Friday, and that's actually why I had this chart as well, is because last week, so these last 5 candles were Expiration Friday week, and you can see how there's basically just nothing going on. The market just is not moving definitively, obviously, in either direction, and that's driven by the expiration of all these options that's happening the 3rd week of this month, in my opinion. And I'll get a little bit more into that on why I think like that. It's just, I've been watching this now for years, and I've been watching the market, it seems like almost every time, but obviously nothing's always. It's not every time, but it seems like it to me. And it's definitely not, but it seems like a high percentage of the time. Leading into Expiration Friday, the market likes to move higher, because there's a lot of puts that are open that the market wants to expire worthless. There's a lot of big money short puts, and that's what I see. So it happened again this week, right? The market moved higher into Expiration Friday. There was a big move higher on Thursday. That was a pretty significant rally, especially after Wednesday, right? So this is how crazy Expiration Fridays can be. You have Wednesday here where we sell off. The E-mini, right? Futures close at the low of the day. And then Thursday, the market has a huge, strong rally and just rips all the bears' faces off. Gets all those puts, right? All those puts that were being bought that were elevated. The IV on them was elevated. The VIX was elevated. All those things, they just rip everyone's face off, get all those puts to expire worthless. And, that's kind of what the trend that I've been seeing for a long time in the market. Now, that's obviously not always going to happen. And at some point, the market's going to crater and it's not going to come back like it did on Thursday. But we do have to be aware of trends and things that continue to happen over and over again in cycles, right? And this is a cycle that's been happening for what it seems like to me, for a good amount of time, because we've been in a bull market. It's just a lot of the time, anytime that there's some type of a sell-off leading into Expiration Friday, the market will then go in the opposite direction, rip higher. So there's a lot of motivation to get all those puts that were bought the day before to just expire worthless and just implode themselves. And that's kind of my idea behind it. But we did see it again this week. The market went higher. So, like I said, also need to be aware, right, the third week in every month. Okay, the third week in every month leads up to Expiration Friday. Need to be aware of that week because it's even tougher to trade because the market a lot of the time is chopping back and forth. Even if you're in a cycle, even if you're in a trending cycle, Expiration Friday week is still going to be tougher to trade. Still going to be more chop and more volatility because of all these derivatives that are expiring this Friday. There's a lot of interest by big money to have the market pinned to a certain level to get certain strikes to expire worthless, to get all types of things to happen. It's just the derivatives market drives the equity market on Expiration Fridays and the third week in the month, in my opinion. Usually, like I said, I haven't seen a lot of the time, I haven't seen the market sell off the third week of the month leading into Expiration Friday. A lot of the time there's not sell-offs happening, right? It's because that type of movement would cause things to happen that people with big money don't want to happen on a lot of these options and derivatives, if that makes sense. Movements make even less sense going into Expiration Friday, right? Like I just said, on Wednesday, normally, like when you get a sell-off like this candle on Wednesday, when you see the E-mini closes at the low of the day, the market sells off into the close. Normally, there will be follow-through. A higher percentage of the time, there is going to be follow-through the next day. Meaning that if the market's weak, it sells off into the close. A higher percentage of the time, you will expect the market to go lower the next day and get follow-through. Well, the exact opposite happened, and this is a perfect example of what happens with the market when it's going in Expiration Friday. The exact opposite happened, right? It's just the movements make even less sense if you think about it, but then it makes even more sense if you understand that it's all driven by the derivatives and where big money wants the market to be on Expiration Friday. So what needs to be done when you're going into Expiration Friday in the third week of the month? What should be done by everybody, in my opinion, is you should be aware of where the largest open interest numbers are on the index ETFs, on the indexes themselves. But really, if you just use the SPY in the SPX, that should be fine. And really, just the SPY is being aware of where the big open interest numbers are. And also being aware, in my opinion, that a lot of the smart money is short these options, right? So I always think to myself, where is the best place that big money could get the market to pin to get the most amount of contracts to expire worthless? And that's why I use open interest to give myself an idea. And this is kind of the way that I look at the market going into Expiration Friday, and just understanding, right, that if 80% of options expire worthless, there's a lot of motivation and a lot of big money out there that's obviously short options. And what options are better to short? Calls or puts? Puts are always better to short because there's more IV in them. So you're getting, when you're shorting puts, you're shorting a better premium, right? The premiums are more elevated in puts. That makes sense. So that's kind of, because of the week that we just had, this was a textbook, in my opinion, this was a textbook Expiration Friday week. I just felt like this was very important to share with you guys and kind of let you guys into my head and what I see in the market, in these patterns that I see. I see these patterns a lot. This is obviously not the first time I've seen this. So, but it's kind of more normal now. It's happened so much that it's just, it's just normal to me. But these are maybe things that especially beginners would probably never really see or be aware of. This type of stuff that takes a long time to see, I feel like. So I'm glad that I'm able to share it with you guys, because it may be something that you wouldn't have seen yourself for a longer time, if that makes sense. But here's an example of the SPY, the next Expiration Friday, right? May 19th. So May 19th, the third Friday in May. This is a SPY option chain. Now, this is kind of looking in advance. So things are going to change leading into Expiration Friday. But I'm just giving you guys an example of, let's say May 19th was coming up, right? Let's say that this was the week leading into May 19th. This is what I would be doing. I would be looking at open interest on both sides. Open interest on both sides, okay? So when I think to myself, when I look at this chain, I think to myself, where is the best place to pin the SPY to get the most contracts to expire worthless? So it's very clear that, to me, that there's going to be the SPY is definitely going to have a hard time getting any lower than 230, because all of this open interest down here, this is a very significant number, 230,000 puts open at 230 on the SPY. That's a very high open interest. So this is kind of how I start, right? I look, okay, there's probably not much of a chance that the SPY is going to go through 230 by May 19th with all this open interest. So I look and I see, okay, now if we're going into the May 19th week, I'm going to be like, so there's 140,000 here, 111,000 here. Where do I think? So there's hard support at 235 as well, because there's 140,000 puts open. To me, it would be a higher chance that the market's going to go higher, because there's a lot of open interest on this side. And that's obviously not always the case. Doesn't work every time, but it's just to give yourself an idea and kind of think more outside the box and just be aware of where this open interest is, because it definitely matters and it definitely impacts the way the market moves. So yeah, in here you can see, even if you go down to 232, there's so much more open interest at the 232 strike on the puts than there are the calls, that I would have reason to believe that there's not much of a chance the SPY will be lower than 232 as well. And yeah, and then on the other side, 240, I would say on the call side, there's not much, because look at all that open interest, right? So look at all this open interest up here. And like I said, I always think of, okay, where the biggest open interest is, there is a lot of motivation to get these strikes to expire worthless. That's the way that I think. So then when I'm thinking like that, I'm thinking, okay, there's not much of a chance that the SPY is going to be above 240 by the time these expire. Just because there's so many of these open, it's going to be really hard. There's a lot of motivation to get these to expire worthless, right? And so for them to expire worthless, the SPY cannot be above 240 at expiration. And open interest, if some of you guys are newer and you don't know what open interest is, it's the amount of contracts that are open at that strike. Whether they're sold to open or bought to open, there's no way to tell exactly whether or not they're sold or bought to open, but that's just how many contracts are open at that strike. The more contracts that are open at a strike, the more liquid they are, the easier it is to get a good price, the tighter the bid-ask spread, and the better overall they are to trade with the more open interest, the more liquid it is. So these are the types of things that I'm looking at always going into an Expiration Friday. And you can even, which is the third Friday of every month, but you can even use this for weeklies as well. It doesn't work as well, but it still gives you an idea of where, the motivation is, in my opinion. See if anyone has any questions. Okay, I don't see any questions, so I'll just keep going. Now, I'm going to share this PowerPoint, but I'm going to go over the Ichimoku Cloud right now. And I will share this PowerPoint. This link here gives a very good whole write-up about the Ichimoku Cloud. I'm really just going to give charts and kind of explain how it works. I think the Ichimoku Cloud is a really good tool for beginners to use. It's a forward-looking tool, and it's driven off of price. And basically the way it works is, you guys see this cloud, right? So if price is above the cloud, that is bullish, and if price is below the cloud, that's bearish. Now there's a bunch of other things to be aware of as well, but that's kind of the way to start, right? So here, when price was below the cloud, that's bearish, and then here price crossed back above the cloud, that's bullish. And then also when do you see this green line, right? So these are all labeled. So this green line is called the Senko span A. When the Senko span A crosses, that's also bullish or bearish. So example being, when this Senko span A line, right? When this line crossed bullish, this was a bullish cross, the cloud then turned green. So bullish cross, price goes back above, then you get this bullish cross. And the other things to be aware of are these three moving average lines. There is the most responsive moving average line, which is the blue one. Then there's the trigger line, or the baseline that they call it, and that's the red one. And then there's this lagging one, which is the slowest. Once the lagging one comes through the cloud, that's like the confirmation. And the fastest indicator that you get of a possible trend reversal is this blue moving average when price goes above there. So when price goes above this blue moving average, things start signaling that it's possible for things to change. And then basically when you get price moving above these moving average, and then you get price into the cloud, this could be seen actually right here when price gets into the cloud as resistance level and a decent opportunity to try and short, because the cloud's still bearish. And when you come back to the cloud, that's kind of where resistance would be. But once you get through the cloud and you get through resistance, then that's kind of a signal that the trend has potential to reverse. So basically you use this as a tool to give yourself an idea of what the trend is and what needs to happen for the trend to change and getting confirmation and all that stuff. You start with the cloud. When price crosses through it, that's a signal that the trend's going to change. And then when the cloud shifts, so you hear the cloud shift from bearish to bullish, then that's the confirmation. And then you can use these moving average lines as well. But it's a tool that I always have. It's a tool that I usually have on my chart, on my E-mini chart that I watch every day. And it's a tool, it's one of the few actual forward-looking tools. So based off of price, it projects forward. See how it's projecting? It projects forward here where the next actual level of support is going to be on the market and where the market could possibly trade to next, if that makes sense. But I'm not very big on actual like indicators. I don't use a lot of indicators. I like the Ichimoku because it's all price. The MACD is good to spot divergences in, which I've covered a couple times, and we should probably make another video on that, and we will at some point. And so I like the MACD, and then I think the RSI is good to give an idea of when the market's overbought and oversold. So does anybody have any questions on this? Yeah, so Ragu, that's what I'm saying. So, and these are good questions too. This is like my theory, right? So you could definitely argue against it, and that's fine. You know, that's fine. This is just basically me trying to give an example of what I see. But the other thing is, you're right. The open interest, yeah, the market conditions could definitely change. I was trying to use that example of, let's say we're heading into that week, right? Let's say this is the Sunday heading into May 19th week, and then that's kind of how I would look at the open interest. That's kind of what I would see and what I would think. Now, obviously, there's a long time. There's 26 days until then, and the open interest can change drastically, and the market can move. And so it's harder to do that now than it would be if you were heading into that week. And I wouldn't do that now. You know, I wouldn't. I'm just giving an example because, Ragu, so Expiration Friday just passed, and we just saw how the market, in my opinion, I mean, it was clear to me, maybe not so clear to others, and that's fine, you know, that this Expiration Friday was a perfect example of how the market is manipulated and driven to certain prices because there's motivation to get the market to that point because there's a lot of derivatives that people are short and they want those obviously to expire worthless, if that makes sense. That's just my opinion, what I see in the market. Do I have any way to actually quantify that and prove it? Not really. It's not really quantifiable, I guess you could say. I could try to quantify it. That would take a long time. It's just something that I see in the market that I wanted to point out. And I think that this week was a perfect example of it. And you could definitely argue against it and say X, Y, Z. You know, how can we say that the market... Yeah, I mean, it's tougher to say that the SPY isn't going to go below 232 by May 19th. I was kind of giving an example of, say, where this is May 13th or whatever, right? So I was saying more along the lines of, let's say it's May 14th and we're looking at that option chain. And then in that case, I would say it's very hard for me to believe that the SPY will get below 232. But when we're going out 26 days, it's still probably less likely, but it's harder to say because so many things can change between now and then. But when you're heading into the week on a Sunday, I think it's a good thing to look at and a good thing to be aware of. And let's see here. I mean, we can look at this again, and I can kind of try and explain to you what I'm thinking here. I'm just saying there's a lot of open interest here, right? So it would be tough if today was May 14th, right, the Sunday heading into May 19th, my idea is it's going to be very tough for the SPY to get below here because there's so much open interest. And even with this, right, there's 140,000 puts open and only 111,000 calls. I would think that we probably are going to finish the week above 235 because these need to expire worthless. And like I said, when I'm looking at options chains, I'm always thinking, heading into Expiration Friday, I'm always thinking to myself, how can the big money get the most amount of contracts to expire worthless, if that makes sense? That's kind of what drives my whole theory, is how can big money get the most amount of contracts to expire worthless on these big ETFs? And that's what's going to drive the market for that week, in my opinion. And I've seen it time and time again. You know, I've been watching the market for years. I've seen it happen a lot. Could I quantify it if I really tried? Probably. It would take a long time, and I'd have to build the stuff out and all that stuff. Maybe it's something to look more into. It's probably can be quantified to some extent, that it's there, that what I'm seeing is there, but I don't have any way of, besides me saying that I've been watching the market for years and seeing this go on, and it just happened last week, right? Last week was Expiration Friday, and the exact thing that I'm talking about happened, where all the open interest was obviously lower, and there was motivation to get all of those options to expire worthless, and the movements didn't make any sense, right? Last week's movements didn't make any sense. It was all driven by open interest and derivatives. So yeah, but you could definitely, everything in the market's subjective, right? I can't say, there's nothing that I can say that I'm 100% right. You know, that's not how the market works, and it's almost not how anything works in life. There's always a case to be made for the other side. And if you're a person that's too close-minded to be able to entertain the other side and the other thought of anything, then you're going to have huge issues, not just in the market, but in life. And even bigger, it's going to be very tough to succeed in the market, right? There's no anything in the market that's always guaranteed, and everything in the market there's always the other side of the trade, right? There's always the other perspective. And that's why when I'm thinking, I'm always thinking, right? So I'm always thinking about both sides. And that's why I come to this, because how many people do you think actually think about this the way that I'm thinking about it? Probably not many people besides the big money that's actually doing what I'm saying I believe they're doing, is the way I look at it. And and you could definitely argue that you don't see that and you think this is an incorrect theory, and that's fine. I'm just sharing with you guys what I see, and if that can anyway help people moving into the next Expiration Friday, the next one, that's really what I wanted to do. I just wanted to help people, and I want people to be aware, at least have this on their radar. It doesn't mean that it's an exact science, right? It doesn't mean that like the biggest open interest is where the market's going to pin. I'm not saying that at all. That's not the case. I'm saying the open interest definitely has an impact on the market leading into Expiration Friday, in my opinion. Yeah, no problem, Raghu. And don't feel shy to challenge things either. I've read things about some of the best leaders, some of the best people at what they do. I think it was Paul Tudor Jones, or one of the biggest hedge fund guys, runs his hedge fund with the intent of making sure that people are challenging each other's beliefs and thoughts, making sure that I know this is like my favorite part about it, is he's not only making sure that people are challenging each other, but he's also making sure that the people on the lowest totem pole, right, like the analysts, the lowest people at the firm, are encouraged to challenge their people above them, right? They're like encouraged to speak up and challenge anything that they don't believe or they don't see. And that's what drives success, and that's what drives a good leader, in my opinion, is being open to being challenged and being open-minded enough to explore the other side of things and even have the ability to change their perspective if they realize that they're wrong, because no one's always right about anything, right? It's possible to be wrong. Like, no one's ever right about anything that they say. So having that type of mindset where I'm open to being challenged, I'm 100% fine with you asking these questions, and I encourage it, I think is a good example of productive dialogue, in my opinion. So thank you for your questions, Raghu. They were all good questions, and I'm happy to engage. And yes, Eric, we will talk more about the Ichimoku Cloud, how you can actually predict it. So how you can actually predict the Ichimoku Cloud is, it's like anything in the market, right? It's hard to predict. I think it's tough. Now, here, basically, what this is telling us, it's telling us that the trend in the market has changed to bullish. So this is, the Ichimoku Cloud here is predicting that the market's going to head higher, right? We're in an uptrend. But it's also giving a prediction of where support can be in the future of the cloud. The cloud is where a high probability of support is going to be in the future, if that makes sense. So it's predicting where support will be, and it's also predicting that the market is now in a bullish trend here with this chart. And here's one of the SPX currently. What is this doing, right? So you see we crossed here. We crossed above the cloud. This was when Trump was elected, right? We crossed above the cloud. We just started trending higher. We started blasting off. And now, since we hit 2,400, like I said, these past 7 weeks, we haven't gone anywhere. We went down a little bit. We've been really magnet to the 2350 area. And the cloud was here already. The cloud predicted this being an interesting level of support, and now we're in the cloud. But what the cloud is telling us is that it's still bullish, right? The cloud's still green. We're just in the cloud right now, and as long as price doesn't go below the bottom of the cloud, and this green line doesn't cross below the red line, everything is still bullish in the market. And the cloud right now on the S&P is bullish still. And like I said, we're still in a bull market. It's just not good to see the market below the 50 SMA. That's not good. And the longer it stays below it, the worse of a sign that becomes. So like I said, this week will be important to see if the market can get back above that level. And the market's really going to be driven by earnings this week, right? Amazon and Google, they're huge, make up a big portion of the S&P 500 and of the NASDAQ. So if they move, when they move, they're going to move the market. And I mean, in my opinion, Amazon and Google are the two best companies in the world. And I'm never bearish those companies. So especially right now, like Amazon just crushing everything. I think Amazon's the best company in the world, in my opinion. It's crushing everything. I'll never be bearish on Amazon. I'll always be thinking that they're gonna have, a good report. Now, sometimes the bar is set too high. Like a lot of the time, when they're reporting for the Christmas quarter, the bar is almost always too high. They miss that a lot. But this quarter, you just go back and look, and I mean, I look forward to the day that Amazon goes down 50%, because it's like Amazon's just a beast, Google's a beast, and those two, they're both reporting this week. They're going to have a huge impact on where the market goes, in these next couple weeks, right? So yeah, I mean, that's kind of using the cloud as on the S&P right here. And it's just a good tool. And when the market gets way ahead of itself, right, you could see it was overextended. The time to enter the trend is actually when it pulls back to the cloud. That's the time where you want it. That's the good entry on the trend, is when price comes back to the cloud. You see how we came back up, now we retrace back, and we've caught up now with the cloud. This price is way above it. So yeah, that's how you use the cloud. This is how you give yourself a tool to let yourself know what the market is currently doing, where the trend is, and what the higher probability of what the next big move is going to be. And clearly, it's still showing the higher probability that the next move is going to be up, right? And that makes sense to me, because I always get worried when there's too many people on one side of something. And to me, all I read about every day on the internet is how bearish everybody is. So I always like to think against the herd. And thinking against the herd is obviously thinking that the market can continue higher, because there's so many people that are bearish. And the second thing with that is, I read a research report, I think I shared it with you guys 2 or 3 weeks ago, written by someone at JP Morgan, that I tended to agree with, saying that, well, before I say this, just everyone be aware, this is one of the longest bull markets ever. We are coming towards the nearer the later innings of an economic cycle, right? So I can understand why so many people are bearish. But the one thing we haven't seen yet, which was in this report, is cycles usually end with huge blow-off tops, huge amount of euphoria, just like what happened in the last two bubbles, right? The last two collapses, the mortgage collapse ended in huge euphoria, and same thing with the tech bubble in 2000. That is, in my opinion, hasn't been seen yet, where everything's going crazy. You know, a blow-off top has definitely not happened, and that's kind of the point that I agree with, and that's why I'm more in the belief that we can continue higher for now, because we haven't seen that euphoric blow-off top type of everyone's bullish, everyone's buying, you know, everyone's making a ton of money. It hasn't really happened yet, but we are seeing a record amount of retail investors come back to the market this year. And like Charles Schwab, they reported earnings last week, and they said this is the most amount of new brokerage accounts they've seen opened in the last 17 years since the tech bubble. So we're getting closer to that. I thought that was really interesting news, that last quarter was the most amount of brokerage accounts they've seen opened in the last 17 years. I mean, that's pretty significant. So we're getting closer, but we still haven't seen that blow off top yet. And that's why I think there's potential for us to head higher. And some catalysts for that can definitely be the tax reform announcement next week on Wednesday, and earnings, Amazon and Google on Thursday. So those are some things. So let's see if anyone has any questions. See how much time we have left, because there's a couple more things I want to talk about. Yeah, Eric, you should look at contracting and expanding of the cloud. It's really not the contraction and expansion, but it's really more the lines, right? These two lines, when they cross from bullish to bearish and bearish to bullish. Now, yeah, these lines are coming closer, so that means the trend's weaker, right? When it's expanding, the trend's stronger. Now, when these are getting closer, the trend's weaker, but really what you should be paying attention to is if they cross. Because when they cross, the cloud becomes red, and then everything becomes bearish, right? Like here, You see how it crossed to red and then it crossed to green? That's really the thing to be paying attention to, is when the cloud crosses from one color to the other, right? This is a bullish cross and that's a bearish cross. So the crosses are really the things that matter. And then, yeah, the size of the cloud matters too, because the smaller it is, the less strong the trend is. So, but yeah, that is something to look at. It's really more important to look at the crosses, right? The crosses from bearish to bullish and bullish to bearish. So Raghu, I am aware of Elliott Wave. I do think that there is definitely something to it, but it's not something that I follow very closely. I do understand how Elliott Wave works though, and if I just off the top of my head looked at a chart, I could give you an idea of what I think here, like in the S&P, right? This could be considered wave 1, wave 2, wave 3, wave 4. So maybe we get a wave 5, right? I mean, Elliott Wave is driven by a 5-wave principle and then corrective waves within it. So you got 1, 2, 3, 4, 5. So we could be making a 5th wave higher. That's what I see here. Or, you know, if you look longer term, maybe this is only wave 1. This could be wave 1, this could be wave 2, and then wave 3 could be huge higher. So yeah, I mean, there's different ways of different wave counts, and et cetera, but it's not something I can't tell you right now 100% what wave we are in and where we are. And that's all subjective too. Elliott Wave is all subjective. Someone could say we're in wave. Someone could say this is wave 5 of something else. Or someone else could be saying this is wave 1. Or someone could be saying this is 1, 2, 3. You know, it's subjective, right? You can make an argument that wherever it is that you want us to be. So that's the thing with technical analysis. It's subjective, and you have to be careful with biases, right? Because you can make yourself see something that you want to make yourself see, even though it's not necessarily there, if that makes sense. So that's why it's really important when you're doing technical analysis to be able to separate the noise from the actual significant move. And because a lot of the time it's noise. And also be aware of your potential to be biased in any direction, right? Yeah, I mean, I don't think it's not very helpful to me, Raghu, in my opinion, because it's so subjective. I don't find it very helpful. But, I mean, some people can, some people do. And my opinion of it is it's really subjective, so. Let's see. Okay, all right, so this is a great example of a stock that just started trending again, and Win, right? I think I talked about Win a little bit already, but this chart looks beautiful in my opinion. This looks like a very pretty chart of a trend that's just starting to emerge. And Win, they report on Tuesday, like I said. I think the date was confirmed recently because there was no confirmation date. Some people were saying the first week in May. So I didn't know when it was either. I just know that the facts are that gaming revenue has accelerated these past couple months. The first quarter the first quarter of this year, and last quarter, Win's earnings started trending up for the first time in 3 to 4 years. So these casino stocks, these gaming stocks, are very volatile. They're good to trade, and my opinion is that Win is going to move higher after its earnings report. Usually, I don't do much on earnings, but I am going to do something on Win because of the reasons I just stated. And a lot of it has to do with fundamental because of gaming revenue in Macau and how that's finally starting to accelerate. So with earnings, you have to be careful. You can't just... I never just... earnings, I need to feel like I have some information that's going to put the probabilities on my side, right? And it needs to be fundamental information because that's what these companies are driven off of earnings. It's fundamentals. The chart doesn't really matter much going into earnings. So, yeah, but that's kind of my outlook on Win is that I expect them to have a good report on Tuesday after the close, and I expect Win to head higher this week. So, yeah, that's my favorite. Win is probably my favorite earnings report of this quarter is Win. So, yeah. And then Amazon. I still like Amazon too. I might do something small on Amazon as well. We'll see. I don't have any fundamental information on Amazon that makes me feel like the probabilities are on my side like I do on Win. I just think Amazon's a monster and they continue to grow. They're on the cloud now. I actually just recently got the Amazon Drive. It's awesome, it's basically cloud storage, right, for all your photos, if you have like a family or whatever. So we were putting all our photos on a hard drive, and being able to store all of your like pictures and videos and stuff on the cloud is the safest way to make sure that you never lose it. So they are a pretty big monster in the cloud now, and they're just getting into everything, and it's a great company. So, but we'll see. Really, Amazon's earnings report could really go either way. Like I said, I don't have any fundamentals, so I might do something on Amazon. But Win is where something I feel like I have something there, and I feel like it puts the probabilities in my favor. So I will definitely be doing something with Win, but Amazon is the monster this week reporting that is going to move the market, obviously, and that's on Thursday. So, and here's another link for where a decent place to look for earnings. I'll share this PowerPoint. And yeah, I already covered all this. Now, I just want to highlight this again in case you guys missed this. These are the biggest... The third week of these months are the biggest earnings weeks of the quarter, every quarter. So we are going into the biggest earnings week of this second quarter, right? Or for the first quarter of 17. So that's that. And as always, I'm always going to have these in here now. These money management rules. These should always be reviewed. I don't think I really need to go into these that much because we've covered them a couple times. But they're always going to be in my presentations now because they're so important for everybody to follow these rules that we've laid out here so that you can stay in the game long enough to make yourself successful. So make sure, if you haven't yet, if these rules are new to you, please make sure you watch the second money management video at least and review these rules and make sure you are aware of them. And just see if anybody has any questions. So, Raghu, I didn't do anything with Netflix. And yeah, I didn't do anything on Netflix. But, I mean, my opinion on Netflix is that it's way overvalued and insane. And if I ever do anything on Netflix, it's always bearish. Because I never think... The numbers, it's all off subscriber numbers. They missed both their subscriber numbers. They've been going a little bit lower. I don't really do much with Netflix ever because it's all just off those subscriber numbers. I really don't have any insight into how how those numbers are going to be every quarter. It's really just a gamble. So that's why I don't really usually do much with Netflix ever. Unless I do a strangle, which I didn't do this time. But I did give that as an example of a good strategy for earnings that's non-directional, not risky, and can make you consistent returns with little risk is an earnings strangle where you sell before the company reports and you profit off the rise in applied volatility. I gave links for that, examples of that, and if anybody's interested in that, I can post that in chat again. Just ask me about it and I'll post the links again. So yeah. But I didn't do anything with that. Does anybody have any other questions? We have five or 10 more minutes here. See if anyone. All right, so I don't see any questions. So let's look at a couple charts for the last of our time. So you guys can see how low wind got actually. How panicked the market was about gambling in China for a while. It was extremely euphoric and then it was extremely panicked. Win at one point was at 240 a share a couple years ago, and then stuff in China started happening, the government cracking down, not letting people in China gamble as much, and the market overshot to the upside when it went to 240, and it overshot way to the downside when it got all the way to 50. So, you know, it has bottomed from 50. It has doubled since then. And still looks like good trending in the right direction now with a lot of upside still. With a lot of upside potential because Win was, like I said, Win was trading, you know, I think it topped out at 260 somewhere around there a couple years ago. So look at gold and some commodities. So yeah, I mean, what we've seen in the market, guys, is we have seen some interesting developments here these past couple weeks where gold has been rallying. The 10-year and rates have really taken a hit, right? So meaning bonds have rallied a lot. So bonds have rallied. Rates are really low. This is the lowest rates have been in a while. Down 10-year down by 2.20. So those are some bearish signals, right? When the gold is rallying and when rates are going lower and bonds are rallying, that means money's going into more safer assets, and that is definitely bearish. So those are some interesting developments. And also oil on Friday got smashed pretty hard, down below 50. So that's also when oil is selling off, that's definitely bearish for the market. So those are some kind of headwinds that the market has here. We can see, gold's above the cloud, establishing an uptrend here. 1300, next important level for gold. And then, bonds, like I said, bonds have been rallying pretty hard, right? TLT. And rates have, the 10-year is the lowest it's been in a while. So, yeah, those are some bearish. And then but the VIX, it did come down a decent amount. Ended up closing at 14, so, but it did come down from 16. So, yeah. But it is still elevated. The VIX up at 1450 is still elevated because we were down at 11 and 12 for a long, long time. For most of 2017, we were between 11 and 12. So the VIX is still a bit elevated as well. All right, so if nobody has any other further questions, guys, we are going to end this session. And like I said, this week's going to be important. We're watching the 50 SMA on the S&P, right? We're watching the 50 SMA on the S&P, which is 2357. So 2357, very important level for us this week. And the market is definitely going to be driven by earnings this week, like I said. So be aware of that. And the big reports, obviously, this week, Amazon and Google on Thursday. And that is about it. And just be aware that we are still in a chop cycle, right? So be aware of the cycles. We are still in that cycle. But we have been in it for 7 weeks, so we should start trending again sooner than later. And that's kind of everything for this upcoming week, guys. That's going to be it for me today. Everybody enjoy the rest of your Sunday. And I will see you all in chat on Monday morning. I'm in the chat every week from 7:30 to 8:30 Eastern Standard Time. Please feel free to come in there and ask me any questions you have. I'm happy to help with anything you guys need help with. And yeah, just I hope I can see a lot of people in there just asking a lot of questions, and happy to help and answer them all. And like I said, guys, just be ready for this week. Be ready and enjoy the rest of your Sunday, guys. And thank you, Rick. I appreciate it. Thank you all for coming, and thank you, Raghu and Eric, for asking good questions. I appreciate it. The more questions that are asked, the better. So, all right, guys.